We have officially hit the noon hour for the East Coast, 11 o'clock Central here. Markets trading a little bit off the lows. Put in a low in the S&P futures right around the 2705. We're about 10 points off that. So good news if you ended up buying that level. But I am pleased to bring back Chart Trader, in which we will discuss his chart book. Good morning, Brett.
Good morning, Jim.
So, Chart Book, is that your autobiography?
Chart book? Yes, very good. Special.
Yeah, well, it is special because people look forward to it every month, and I was reading through it, of course, and you've got some interesting ideas. You always start with the equities at the top, and what I'm going to do is put it on the visual screen so that people can follow it along. However, I do encourage you, it'll get a better representation if you just type in chart and you look for his chart book. He has a link to it. You'll probably get bigger pictures, and you can scroll through it at your own leisure as well. But why don't we start with the equity markets, because he had some pretty good analysis on this one, and I was looking at that 50% retracement in the S&Ps. Is it something that you just kind of noted when you were doing your research, or is it a level that you had been targeting?
I had been targeting it. Well, I'd been targeting it. I've been watching it. It's the level that we came into exactly to the tick when we started to get results from the midterm elections, and I thought that was quite interesting. So the idea of there being a binary outcome scenario related to the midterms, that was the presumption on some level. Looks like it's kind of muddled into a much more complex scenario, as it always seems to be the case. But we ended up on that pink line basically right into the beginning of results rolling out, and I thought that was kind of interesting.
Yeah, very interesting.
Yeah.
Well, we're now below it, so you were looking for potential opportunities here. Has anything caught your interest as of yet?
Well, so a few days ago I got short the NASDAQ, and I had said that I was planning on holding for something close to a test of the lows. And Sunday night was really unfortunate because we got just a completely out of the blue, rip-roaring rally in the futures market in the late evening of like well over 1% in just a few hours, and I couldn't find any cause for it at all, and it went all the way back past my stop. I actually cut the position before it got to my stop for very small gains, but the larger time frame analysis that I was looking for, I was looking for a move back down. As I said last week, I believe it was Friday I put the position on, I said I was looking for a move back down into... let me see where somewhere in the 6750 area, I believe. And so getting chopped out of it at 70, 80, and giving up those extra significant, 200 points,
right,
was really an unfortunate turn of events there. As far as where we're headed, I think that. So I paint a narrative during the first section of the chart book of what I think basically the causal structure is for what's happening right now, and it's really a larger time frame issue, and it's not. I think it shouldn't be oversimplified to be just reactive to political catalysts or to guidance out of big cap tech or something. I think that there's a much bigger picture that the market's dealing with, and the market doesn't need to have anything figured out. It's the combination of decisions by a multitudinous inputs, and the picture that you get is a pretty good information processing machine. And I think, given what we're headed into next year, I think it's better to look at this as an assumption that the impact of fiscal stimulus is going to be gone, or at least not have its second derivative impact. We're not going to see the psychological impact of people. I mean, the most important thing about doing the tax cuts and doing really an economically vitalizing kind of deregulation process is the psychological impact that it has on people as they start to assume that it will control other people's decisions in the future. And so that's something like we saw with QE, and the Fed did a lot of analysis on this. But the idea that business owners see that over coming quarters, people are going to be taking more risk, investing more, spending more, etc. So right now, I need to hire a bunch more people. Or the bank saying, I can lend a bunch more money now because this stimulus is going to help people be able to handle that debt. So that it's really that first step provides the powerful impact. And we saw that in Q2 and Q3, where people started to really raise their level of investment because they need to expand, because they're going to be assuming there's going to be a larger amount of demand for the next 4 to 6 quarters or whatever. So, and it's that actual investment, that risk assumption, that really drives the big result of the fiscal stimulus in the first place. And so we saw that in Q2 and Q3. We saw the excess lending, the excess spending, the excess hiring. All of it has already kind of happened. And when you roll around to next year, next summer or so, you're going to be comparing economic data and earnings data to this period. And that's really the big problem here, is those comparisons are going to be extraordinarily difficult. And at the same time, you're not going to be able to get a new bump of that same kind of push, because we now have the Democrats in control of the House. And, you know, they're probably going to be a bit of an obstruction to processes like that. So there's that aspect of it. And at the same time, you're going to be rolling out enormous supply of treasuries. And I've talked about this argument. I don't need to go that deeply into it, because probably you've heard me talk about it. But just the idea that you're going to be pushing out, you know, over $1 trillion from Treasury of new supply, and the Fed's going to be rolling off $500 billion of its own supply, and we're going to start in the second half of the year with some of the biggest rollovers we've seen in several decades in terms of corporate debt rolling over. So all that supply is going to be competing for the same fixed income bid, and that's going to just keep interest rates higher than really people want them to be. And to circle back around, if you read did you read the last section of the chart book? The little essay at the bottom.
The essay at the bottom. You know what? I don't think I scrolled down just at the very tail end.
The acclimation argument.
Okay,
so I would encourage people to read that part, because I think it really kind of makes the bigger point of the problem with, if you look at interest rates and you say, well, interest rates are only, you know, a little over 3% on the 10-year. Look at history. That's not very high. That's not the point. The point is that it's very, very rare for a market cycle and a business cycle to go through such a slow burn for such a long time with extraordinarily controlled interest rates. And I draw this analogy between life evolving on a mountaintop lake. And if you imagine a granite basin, no salinity in the water, the type of life that evolves there, it evolves with a physiology that's predicated on never having to worry about salt of any kind. So it just doesn't process it that way. And because it's there for so long in such a state, all the life that evolves into the niche of this mountaintop lake acclimates to that kind of environment. And then I contrast this with the notion of an estuary, which is where the title of the chart book comes from. An estuary is a kind of borderline freshwater, saltwater environment where salinity is extremely volatile. If you go to one area of the estuary, it's really salty. Another area, it's freshwater. It's all mixing. The tidal currents kind of push things around so that you for any life that evolves in that kind of environment, its physiology is going to be predicated on being able to withstand a tremendous amount of shifting salinity levels. So a move higher at this stage of the cycle, because of how long we have been in such a controlled interest rate environment, when we start to see the type of acceleration we saw in September in interest rates, that's a bit like taking a fish from the mountaintop lake and setting it loose in the estuary. It's just not evolved to be able to handle that kind of environment. And this is normally not a big deal. For most cycles that we've seen over the last few decades, if you think of the cycle as being made of two parts, the mountaintop lake part and the estuary part, you know, once the growth starts going and we start to take off the counter-cyclical elements of monetary policy, we start to move toward, you know, being more worried about inflation than deflation, is a simple way to put it. We don't stay in that mountaintop lake part of the cycle for more than a couple quarters, typically. You know, and we start to move more into the estuary part of the cycle. And this cycle was really weird because we stayed in that mountaintop lake side of the cycle for 7 or 8 years. And that's a very strange phenomenon. And if you think about what that means in terms of like the life cycle of Wall Street, you've got people who've come into careers. You've got funds that have opened and shut down in that time. You've got all of these processes that have happened. You've got iterative qualities that have developed over that period. There are plenty of people right now who think of themselves as experienced money managers who whose careers started inside of this cycle, and they've never known anything but a super controlled interest rate environment. And so they're kind of like that fish that has a physiology predicated upon no salt in the water, and then it's thrown into this estuary. And there's a number of impacts of that kind of shift that are really difficult to understand, but probably are going to be more impactful than it may at first appear. And I know this is a really abstract kind of notion, but if you circle back around to the opening section of the chart book, I talk about a model shift. And I think the model shift is the primary thing that's driven the downside that we've seen so far. And that basically is we've had so much money that has gone into a kind of portfolio management strategy that is predicated upon this sort of negating process in terms of the relationship between different asset classes. We see kind of risk covariance assumption when you hold stocks and bonds, that you're not going to get burned by both at the same time. And that's been kind of written into the DNA of how a great deal of money is being managed. And if you look at just the most direct terms, you're looking at risk parity portfolio managers, you're talking about $500 billion. But it's really much bigger than that. And I think we talked about this last time, but if you look at robo-advisors for people's 401ks, this is also basically the assumption that's written into that. So there's just a ton of money that is involved in markets with the basic assumption that when you're holding stocks and bonds, one side is going to protect the other. And the moment that starts to break, it's going to cause a much bigger hiccup than I think people realize, because it's been so baked in to so much money. It's a plumbing issue, but it's a really big plumbing issue, and I don't think it should be overlooked. And I think it's probably the primary catalyst for the downside that we've seen. And that's been accented by some other elements, including politics and including some of the guide downs that we've seen. But I think that it's still probably the initial first mover that's driven the downside that we've seen. So they kind of tie in that first section and that last section to try to give a more sort of qualitative sense of why this would be a big deal. Because it's a weird cycle.
So if you were to handicap, how long do we stay in this type of range, considering we were in that environment for what you said, 7-8 years? How long does it take to come out of it? How long does it normally last if we're in a normal cycle, and then how long can it stay in? How long could that environment stay in play?
Well, so, I mean, we've moved out of the environment now, so we've moved into the more typical, we think of it as a late cycle element now, but, it's only late cycle because it seems like such a long cycle, but this is more typically the type of environment that evolves into place as you get into even a mid-cycle stage, when people are more worried about inflation than they are deflation. Interest rates are more volatile, and stocks and bonds can spend long periods going in the same direction, up and down. That's not that crazy of a phenomenon. That's a typical way for the market to behave for the majority of any given market cycle. And in most market cycles, the period that we saw, if you think of it, it's like there was a prolonged infancy. Like if you think of a person that stays being like a baby for about 60 years, and then suddenly it becomes an adult. Like, that's the weirdness of this cycle, is we stayed in that early stage, odd kind of environment. And it's a testament to the fact that, if you think about it, it was early 2015 before the EU started QE, right? The bottom that started this cycle was March of 2009. And at that point, we were on QE here until late 2014. We only started to dish the balance sheet out in 2016, 2017, right? So we're talking about almost a decade in before we get out of sort of life support kind of monetary policy. And in that mountaintop lake, just really controlling where interest rates are allowed to move. And the problem that I'm highlighting is, when you do that, it's not just that you're causing the potential for greater inflation by putting more money in the system or whatever. I don't know whether that's a big problem or not. I guess that'd be the typical argument against that type of policy regime, is that you're baking in a lot of inflation. But I don't know. There's a lot of structural factors that are controlling that. I think the bigger problem is that you have almost like I just keep mixing metaphors, but hopefully you don't mind. If you have like an animal in a zoo for a long period of time until it gets old, and then you set it loose. If you have a controlled environment and people learn, they acclimate to a very controlled kind of environment, and then market forces start to take over. There's going to be a lot of unknown unknowns in terms of the variables that start to come into play, because you baked in a set of assumptions, and the life of the market has evolved around those core assumptions and become very fixed on those ideas. So it's not a flexible system, and then you force it to become very flexible. And there's going to be a lot of speed bumps that are related to that, and I think one of them is what we're kind of going through now. We're adjusting to that, and it's causing a lot of risk aversion. And this can feed nicely into the sentiment data part of this, because if you scroll down past the initial equities part, there's a sentiment data point that I don't normally talk about because it so rarely shows an extreme, and but it's a good indicator, and it does show that risk aversion being extraordinarily highlighted right now. It's the equity hedging index, and I give a brief description of it. Basically, it's just taking into account all the factors that you think you'd see during a sort of risk-off move in terms of the choices that people make with implementing in assets. So it looks at demand for cash, demand for puts, demand for inverse ETFs, demand for inverse mutual funds, demand for short interest in equity index futures, and demand for CDS, credit default swaps. So if you take all of those things and you measure relative demand and you give them a relative score to their own history, so an internal history, cash now versus cash over a period, put buying now versus put buying over a period, you get that relative score, and then you take an indexed average of those scores across those 6 measures. That's what the equity hedging index is, and it's very rarely up to 80 to 85. It's only been there, 2 or 3 times in the last decade, and it's there now. And that's interesting because it didn't even get close to that in February, and you'd think with the volatility that we saw in February, it would have been more likely that would have been the case. So people seem to be taking more seriously the possibility that there's a big problem happening right now than at that point. And that has been a very good contrarian indicator. When you get to this level in the equity hedging index, there are essentially no instances in history that I could find where you immediately continue lower for a prolonged period. There's no instances of that. So this may be the first time ever, but even if you're set to continue lower, a good example of what that looks like is 2008. In 2008, we saw a score basically the same as this, but it was around the Bear Stearns collapse. And what happened after the Bear Stearns collapse, as I point out, is a 13% 2-month rally. So even in the situation where it was the beginning of a genuine and vicious bear market, when this indicator reached that score, the next 2 months saw 13% upside. So that's where we are right now, which is why it's been very difficult for me to put that short back on, because it's hard to go against that data history and an indicator that's got so many different inputs and is so robustly constructed.
All right. Well, I think that helps. Maybe we had a listener question asking if, based on your morning note today, that you thought the market may need to take another dip, and they were wondering why you didn't take a short this morning.
For that very reason, it's even if I think that there's a decent chance that the market's going to go down, I need to see a setup I trust. Mm-hmm. And I was looking at it. I almost did, and this is going to sound ridiculous. Okay, it's going to sound like, oh yeah, right. I almost did short the very, very top in the Nasdaq, and I didn't, because I didn't feel. The pattern was there. If you look on a 1 minute, 3 minute, or 5 minute chart, there was a pattern of a wedge top that is relatively clear, and it's something that I would typically look for as a short off of a gap up in a downward trend. So that's just a very basic and good setup. I didn't take it because I felt like the gap up was not necessarily generated by some kind of headline driver, and when I think that there's a lot of people hedged and a lot of people short, and we get a gap up that doesn't seem to be driven by a very specific catalyst, it's kind of a rule-based call to just say, you know what, the thing that I'm not going to do is fade strength, even if it looks like there's something like a wedge, because one of the implications of a wedge, it can be either that there's a kind of lead blanket offer coming in, or it can be that lots of people are really bearish and trying to short it. And you can get 2 outcomes to a wedge. One is the one that we saw today, which would have been nice to be short. But the other is it dips down just a little bit and then powers through the top of the wedge, and you get kind of a blow-off. And that wedge turns into looking like something that's an accelerating kind of, parabolic sort of move. And that's because the people who are forming the wedge are really people who are just trying to come in and short the crap out of the market. And eventually they get past their breaking point and everybody covers. So since we're in a situation where I know that we've got this equity hedging reading, and since the gap up today was not driven by a particular headline catalyst, I laid off it because I felt that the odds were too far in favor of the possibility of that blow-off outcome. Turned out not to be the case. Market turned out to have rolled over. It would have been a nice place to be short.
All right. Well, with that said, is it yet a nice place to be long?
So we didn't see an extreme in the put call reading on the way down, but at some point it's going to be a nice place to be long. Like just based on that sentiment index, I would rather see a greater buildup of downside momentum, kind of like if you imagine a rubber band just being stretched really far, simply so that the snapback gives you a tremendous amount of momentum. And I don't feel like we have gotten there. It's not too much further, but again, I said that my target for the short in the NASDAQ would be around 67.50, and maybe if we get down to that level and we do show that kind of support, or maybe if we move and really blow out the underside of the 2,700 level in the S&P. But, it's going to, at the same time, these are, like we've talked about, sort of two-level utilitarianism here that I kind of look at this and I have these ideas about what I'd like to see. But at the end of the day, there's really there needs to be a confluence between what I'm seeing in the tape and the rhythm and the tone of the market with what my larger, more abstract ideas are about what I'd like to see. And so it really probably will come down to just my instincts based on how it's trading at a particular moment. And I haven't had that irresistible compulsion that this is a setup that I have to be in. So I'm just waiting for that.
All right. Well, we did get as low, probably either right when we were talking, we got a low in the NASDAQ futures of 67.84. Pretty close.
Yes, pretty close. So let's watch how this pattern builds out. There's probably going to be people coming back to try and knock it back down through because that's been the pattern. And it really needs to be probably several efforts to try and knock, if there's no headline, several efforts to try and knock it down through. And, something similar to what you saw overnight in the S&P a little bit. We kind of saw some of that sort of feeling of like a period. If you look at the last 2 days on like a 15-minute chart in the S&P, you see several attempts to break it under 2720, and then, we dipped under it a bit more, and then when we got back above that level, we took off into this morning. You might see a smaller time frame version of that kind of process to put in a more important low today. Several attempts to break it down under that 67.50 area, maybe a little bit of a bite underneath it, and then just kind of a vacuum flush to the upside. That would be a nice way to kind of give me a little bit more of a sense that we've exhausted real sellers. We've gotten to people who are just kind of instinctively trigger-happy pounding the bid, and there is some kind of semblance of a more important bid that's sitting there.
All right. Put call ratio hitting 1.2 doesn't do it for you?
No, not in this type of environment.
All right.
I would want to see. Yeah, I'd want to see, especially midday at this point. If I see, somewhere between 1.35 and 1.5, I would like to see.
Okay. So, well, maybe if the VIX was 9, 1.2 might be a good level for you in the put call ratio, right?
It could be. Yeah, I don't know.
No, that
I
just
could go the other way. Actually, I would say the opposite is probably true.
What's
I
that?
think that it would need to be higher if the VIX was lower.
Oh, really? Okay.
Yeah, because it would be a sense that there's more of a crowded long position already in the market, so I would need to see more panic to want to buy.
All right. Well, yeah, that definitely makes sense. All right. Have we exhausted the equity talk for now?
Yeah, I think so.
All right, well, let's move on to crude oil, where things have really gotten interesting. Had a big down day yesterday, and today we've rebounded a little bit. And I asked Gavin if this was a dead cat bounce or if it was something real. You haven't gotten involved in crude oil, and I almost hate to ask this question, but is it too late to chase it?
Depends on what your outlook is. I know what setup I want, and I don't see it right now. And as we always say, you and I always talk about, I'm perfectly fine to let something go away from me.
Mm-hmm.
I don't need to be in crude oil when it bounces. I think that that's an important instinct to give up. If you feel like you need to be in something, it's generally a problem. I feel like I've got an idea of what particular setup I would really like to see. And at this point, I would like to see a puncturing of the highs that we formed in late 2016 and early 2017, which really represents the area between about 53.50 and 54.50. I think that if we get down into that range on that long-term chart, I don't know if you saw, late yesterday I posted a longer-term chart of crude oil on the continuous contract showing the trend line break that I think really kind of set off the plunge we saw yesterday. And in my experience, when you get a very directional sliding run into a trend line and then you accelerate massively on the trend line break, 99% of the time, there's an overshooting day. So you get the initial big bar down that closes just about on the lows. Maybe you get a sideways day in there, and then you get a tail poking underneath it. And that would poke right into that area that I would like to see it, where I feel like there'd be a ton of support, because that is an area where you really get into that element of the equation where U.S. shale almost becomes something like a U.S. production cut. If you think of an OPEC cut, that would provide support to the market. You get a kind of automatic cut in production when you get really kind of under that, the top of that range, because that was really all about the area where, it's profitable for most people in the shale industry to be doing a bunch of volume. And when we broke above that last year, that was really the point where we moved into a period of profitability, and we got a kind of chasing in terms of people taking off hedges at the big shale companies. Because suddenly, it was terrible to have hedges on. It's terrible to have hedges on when, you can sell the oil for much more because the hedges are selling the in-the-ground production ahead of time. And so those hedges needed to come off, and they were huge, and they were in there for a while to help some of these guys survive the process that we went through from 2014 to 2016. And so that process, it was a really important threshold to break through, and I think the market has kind of painted that area as the sort of line in the sand about where the industry as a whole is going to be doing more, doing less in terms of production and in terms of hedging. So I think we could get the hedges helping, maybe some hedges being reassumed and taking us into that zone, and then we could get a market that starts to discount the idea that U.S. shale production could start to be curtailed as we have the threat of moving back into that unprofitable area. And one thing I would point out for those who are regularly involved in crude oil, it's important also to remember that the bank fall redeterminations have already passed. So we're in a situation where we're on the other side of that. So the redeterminations, essentially the loan books out from the banks to the commodity producers, they reassess twice a year, spring and fall, and it's already passed now. That was last month for the most part. And so the idea that the move that we saw yesterday and over really the last 2 weeks, that would not be involved in those redeterminations. The banks did not take into account the possibility of unprofitable shale companies, and the in-the-ground value of their resources might not be worth enough to keep them solvent when they determined which loans to renew. So there's going to be no capital problems. And one of the big problems that we saw a few years ago is when the redeterminations happened after a break under that profitability line, and the banks started to pull credit. And so you got a lot of bankruptcies in the space, and that really just crushed some of these companies. And just the risk of it and the need for massive hedging to try and be able to come up with a loan-to-value kind of relationship that allowed them to keep lines of credit open. So my point is, the banks went into redeterminations this year with the idea that these guys are easily very, very much profitable with what they have in terms of their in-the-ground. Now, if we saw this as a bear market that continued to develop for another several months, and we come into spring redeterminations at $42 a barrel, that would be a very different situation, and you'd start to see a lot of the companies involved that are dependent upon U.S. shale just really fall apart because there'd be credit pressure. So I'm just pointing out that if anybody's really kind of thinking about the side of it that became so important a few years ago with the banks, we're past that now. They're sort of in the clear. So I wouldn't worry about that. I think that you have the possibility of an effective kind of policy cut in U.S. production if you get below 55, maybe below 54. And just based on my experience with a trendline break like this and looking for that follow-through day, that's the setup I would like. I would like to see that spill, that extra level, take small size, very wide risk, and look for a move back to maybe 62 to 64.
Do you think that there is any chance, based on some of the things, some of the tweets and whatnot, some of the commentary from President Trump, that he may do something from, I don't know, subsidy standpoint to offset whatever OPEC may have up their sleeve? You know, he's been very verbal about the price of oil. Is that something that may be not talked enough about? Is that part of the ammo that he may have to offset anything that OPEC may do? Because he's talked very openly about oil prices being too low, even at these levels.
Too high.
Yeah, I'm sorry, being too high even at these levels. Right.
Even at these levels?
Yeah.
Really?
I think so.
That.
Well, I mean, it wasn't that long ago.
I think he wants that range. I think he wants the shale guys to be profitable. I think they're big donors. I think he doesn't want 75 and up. But I'm not so sure. I would be surprised if he wants the U.S. energy industry to be crippled. So there's that threshold there.
Well, if he was saying it
into a lot of these companies being really hurt.
I mean, if he's saying it when the price of crude is around 65 and we're trading, 58, there's really no difference, right? Is there? Is it that big of a difference?
I think there's a critical difference. I think, there's not, 58's okay. I think he'd rather 60 to 62, but 50 is a problem, right?
Okay.
So I think he starts to play with fire at that point if he tries to crimp OPEC's policy control of the market, unless there's a bigger game at play. Maybe there's a bigger game at play and he's willing to risk that, but I would think that, there may be a bigger game at play. I mean, obviously, there's been a lot of tension growing up between the Saudis and the U.S. now.
Right.
And that's really the way that the Saudis can exercise control, and just maybe to try to put pressure on them. Perhaps there's a negotiation going on that we don't know about, and this is a way that he can kind of say, hey, I'm going to make you poor unless you give me what I want, and maybe there's something that he's asked for specifically from them that I don't know about. But other than that, I think that, saying that oil prices are too high is just another tool in the populist tool bag, and I think most of those statements were ahead of the midterm elections. So I'm not sure if that sticks around too much, especially if we've got a U.S. energy industry that's really important to the economy, probably really important to campaign fundraising for the Republican Party, and, we are in a situation where these guys could be suddenly, unprofitable again. So I would think that there's a line there that he wouldn't want to push oil below.
I just wonder if there was, maybe some he's got in his bag of tricks something in which he might be able to pull. I don't know. You would know better than me. I think there's personally, I just think there's a bigger game, as you said. What that game is, I don't necessarily know. I just find it hard to believe that he would just talk for the sake of talking without having something up his sleeve. Maybe he does. Like you lay out the politics and know the economics much better than I do, and you can speak much more eloquently than I can. It just seems that there would be something else logically that he would have up his sleeve to, I don't know, subsidies. Who knows?
Yeah, I don't know the answer to that question. I mean, I suppose that Saudi Arabia is a very important strategic asset in terms of relationships. No matter what, no matter whether you love them or hate them, they've got a big chess piece in the world, and I suppose that having leverage there would be an important asset. And just in the abstract, there's some sense to be made there. But I don't know of a specific narrative that suggests that there would be worth a risk other than, populist rhetoric ahead of an election to just say, I'm part of the force trying to make life easier for you guys type of thing to the American voters. Because people have I think there's a simplistic understanding probably on the part of most people in terms of the importance of crude oil prices. Most people, probably in their daily life, go ahead and, ask your next door neighbor, probably think, hey, it's good when crude oil prices are lower than higher, generally speaking. But there are second order consequences of that. It's like the drug pricing debate. There's, on the one hand, do you really think that some child with leukemia should not be able to afford a drug that can save him? But on the other hand, drug prices are something like, if you think of the Old West with a bounty hunter poster, like what you really assign as the value of the bounty on that guy who murders women and children is really going to have to do with whether or not somebody invests themselves in trying to take out the murderer, And if you price drugs too low, if you force too low drug prices, then you get, brilliant people and big financing to no longer want to be involved in things like curing cancer. And there's a second order impact there that's devastating. So, if you want somebody to be, investing themselves in trying to do that, you kind of need to put a high bounty on the villain that is cancer. And at the same time, with crude oil, if people take a moment to think about it, their economy will collapse if the price of crude oil is too low. So you're going to lose your job, even if your job seems to have nothing to do with the oil industry at a certain point. So there's a delicate balance to be struck, and I think populist rhetoric is usually phrased overly simplistically, but it doesn't necessarily translate into post-election policy movement. And so I'm not so sure that this will be something where there's a worthwhile risk. But again, you're right. There is a chess game going on with Saudi Arabia, and it's not impossible that this is a leverage play, and he just wants to show them that he can take away their tool, because they thought, all they have to do is they control OPEC, they make a big production cut, they get the price to go up. If they think that it's that easy for them, if he just demonstrates that it's not that easy, that he can actually have more sway over that situation than they can, I'm not sure that that's true, but if he believes that, or if he makes them believe that, then they need to play ball with him. So that may be part of the process of just demonstrating to them that he's an important asset to them, and that he has, certain demands or whatever, and they need to play ball with him. I suppose that that's a possible narrative as well. I don't know. I don't see it, though. I don't understand it, and maybe I will at some point, but right now I would imagine that there's a populist rhetoric issue ahead of the election, and there's also an awareness, probably through, the Department of Energy and, what's his name, the guy in Texas, the former presidential candidate, Rick Perry. Right? Rick Perry's probably getting phone calls from lots of folks saying, hey, why is this guy doing this to us? And Rick Perry's probably getting in touch with the president and saying, hey, we got lots of folks who are going to be really upset here if you keep hammering the price of crude oil down. Like, I imagine that line of communication's open as well. So there's a pushback at a certain level in price.
All right, and the only reason why I brought that up is because we do have that OPEC meeting on the horizon. But let's set that aside for a second and talk about the CFTC commitment of traders' data. Now, let me toss this idea out to you. And
all right.
So we know that the CFTC data is collected on Tuesday and then released on Friday. Yesterday was Tuesday. So do you think that sell-off might have had anything to do with positioning so that there will be a new set of data to look at? Maybe they wanted that off the books or however it's collected. But is there any rationale to the timing that it just so happened to be on a Tuesday?
I don't think so.
Okay.
I think that you can write a blog article that could be compelling to people on that point.
Oh, and it would good idea.
You can get a popular Google search blog article going and publish it in chat rooms. And I think that it would be wrong. I don't think that there's I think that would take an extraordinary number of additional assumptions, and kind of an Occam's razor view would deny it. But I think that it is an important coincidence. Now, it starts to almost get to the point where, what time of day is the data collected, right? I mean, that starts. Is it after pit close? I guess it's probably after pit close.
It would have to be, because it has open interest, right? And that's when the data is collected. They don't do that on a real time basis, do they?
No, right. I mean, but I don't know how long it takes to get people to. You're dealing with a voluntary process here too, or at least you're depending upon people to submit information. And I suppose they could say you have to submit it ahead of midnight But do they say you have to submit it starting after 4? I mean, you're talking about people who are required to submit what their positioning is, or not. Based on, I mean, that's really the categories here. Like, if you have a certain amount, you're required to let the CFTC know that you do. And then the rest of the open interest is seen as the small speculators. So, I suppose that it would matter what time of day we're talking about, because it was such a dramatic move, and it seems to be a dramatic move of that puke that we talked about, where the speculator interest should be far lower when we see it on Friday if it's accounting for that data. So, I mean, so I'm almost thinking that I see it now as it said 403,000 large speculator long interest as of when we got it last Friday, and I'm always assuming now we're going to see 330,000, even without seeing the data, which would be a low amount. In the grand scheme of crude oil, that's a significant drop. That's a significant lack of large speculator interest. 330,000 is what you get around bottoms often. So I think that's what we had back in when we got the bottom that we were talking about last year in May or June around the 42 level. I think there was about 330,000 then. So we're at 403,000. If we lost another 75,000 large speculator contracts yesterday, then that may be where we are now. And so if I do get that overshoot, it really feels to me like it will be an interesting opportunity. And I just like to see that pattern that we talked about just reaffirmed, that overshoot day from the big trend line break, and then you get maybe that big rubber band snapback. But I can't imagine that the fact that it was Tuesday was a contributing factor. I suppose there could be a few orders at the end of the day where, but I still don't see necessarily the motivation. So.
Oh man, always shooting down my conspiracy
I love
theories.
Conspiracy theories, though, Jim, and I think you're fantastic at them.
Yeah. Well, if you come up with enough of them, you hit, right? The broken clock conspiracy theory.
It's beautiful.
Yeah, well, that'll be the name of my blog. All right. So, all right, look for that one next Tuesday. I got a moonlighting gig already. Thanks. All right. So, is there a particular price? You don't really look for price, but for our listeners' sake, and we'll keep it very, very simple, is there another price point that you want to see with big volume, maybe that 55 area, because it's well below that shaded part that you indicated in...
well, I'd like to see 53.50, as I said.
53.50. Okay, I'm going to write that down.
We got to 55 last night. I would like to see an overshoot of that.
53.50. Got it.
It may not get there. I mean, 54.25. I'd probably take. It would depend on the feel of the tape. I'd want to see it be, something that I recognize in my data file of memory. I've traded crude oil. I haven't traded crude oil that much, and so for anybody listening who has been with us maybe for a short period of time, I trade crude oil a lot, and for years and years and years and years and years. And there's been periods where, for even as much as a year or two, it's the main thing that I've traded. And I've got a very specific set of kind of patterns that I'm used to seeing at certain types of movement, and particularly in terms of looking for things like downside exhaustion. And if I recognize something that looks like an important signal to me, and it's at the level that I want, I will make sure to be involved.
And you got involved yesterday, just didn't quite see the action that you wanted.
It was exactly right. I mean, it started to show me something where I was like, boy, I wish I was short right now. And it, indeed, it went down another 100 ticks. Mm-hmm. And I wasn't watching when it started to curl to the upside. There was an overnight pattern that looked actually like a pretty decent, if I had been sitting there at about 2:30 in the morning, maybe 3 o'clock in the morning, there was kind of a little bit of an ascending triangle after a failed attempted retest of the lows, but the volume is low, so it's a little tough to tell. But overnight is when, as you've noted many times, overnight or on Sunday night is when we often get the important extremes in crude.
Well, you know what, Brett? I'm up at that hour. We can have a little partnership if you want. I'll be your overnight guy. All right, I'm going to hold you to it. Right. Yeah, we're going to talk offline. Yeah. Look at that. We're making deals here, coming up with business plans, vlogs. Look at that. Most interesting segment that we've had. Yeah, yeah. I mean, we got all kinds of ideas flowing. All right, so wow, 45 minutes has went really fast. We'd be remiss if we didn't talk about Europe at all.
Yeah, I mean, this is it's like a slow motion train wreck to me, and I just and market knew it was coming. I think it's so interesting that. I mean, this was it, right? This was Brussels saying, okay, tell you what, November 13th, you come back to us and you have things straightened out. We'll let that other thing you were trying to do slide. That's the message to Rome. And then everybody in the world knows it and sees it. Rome is going to come back with the exact same budget and just kind of flick them off. And that's what we got. And and the market knew it was coming, so, it had already been accounted for to some extent in pricing. But I think it's a little bit remarkable that it's just so passé to the market here. Like, I guess because it seems like choices people are making, and so they could make different choices if we got to more crisis level kind of indications from markets. So the market's not really going there because it assumes that if things kind of get crazy enough that everybody will sober up. But I just don't think that's what you're going to see. I think that this is heels that are dug in and sealed in concrete 10 miles away from each other. And this has implications for the survival of the European Monetary Union. You cannot survive by catering to what Rome is doing, and yet there's a perfectly good argument for Rome to be making that seems like that is in their best interest. And it just highlights the sort of inviability of the European Monetary Union, and it can escalate to highlight that for everybody on a greater and greater level. This is a seed of something that has implications. It is a fundamentally flawed organization, and I've talked about it before, but really, the next time that we have a down cycle economically that is important, and we just saw Germany with negative growth, by the way, and the European equities market is now in a bear market. And, we're kind of maybe seeing that. And I'll tell you what happens in Europe. When you have down cycles, all of the stuff that's a problem, that is fundamentally a problem in the structure and the organization and the protocols that underlie the European Monetary Union, all of that stuff starts to come to light. That's what we saw from 2009 to 2012 when the whole thing almost completely fell apart. It's great in good times, and everybody's fine with it in 2005, 2006, etc., and, 2 years ago. But when things start to go wrong, you get pro-cyclicality. So what that means is, just like what Italy's complaining about, when things are tough for them, they're forced to use austerity. And that just reinforces the tough times. You're supposed to, according to a kind of Keynesian model, there's breaks from policy systems. There's expanded demand from central authorities to try and make up for demand that's missing, so you don't get a tragedy of the commons kind of dynamic. And when things are moving in the wrong direction, like they are now, and you're being forced to use austerity, it causes problems. And so Italy is right to kind of push back against that. However, at the same time, it's not a possibility to have the organization that they have and all of these other countries involved and to have a set of rules that are made to work like that, because you do not have a fiscal side to it. It's just a monetary union. If it was a fiscal union, it would be something like the way that states work in the United States. We can use federal tools to help buffer downside in certain states when those states aren't doing as well as other states. We have bailout programs and things like that. And that's a fiscal union, and it helps. We can take full national tax receipts and use them if there's a crisis somewhere. But if we had just the same currency and no fiscal union, we would see the same problem. We'd have states really angry at Washington, D.C., and you just kind of see an analog there. And they would need to adopt their own currencies so they could do their own counter-cyclical programs to support them in times when things are difficult. And it's just a fundamental problem. And I'm surprised that the market isn't reading more into this particular spat, because it seems to me to have much larger implications. And I would imagine that eventually it's going to seem to everybody to have larger implications, because, again, I don't think either side can give in, and there's no way they can compromise. There isn't common ground right now. and one side or the other would have to dramatically move away from something that I don't see as possible for them to move away from. So, and Italy, again, is the third largest bond market in the world, and you can't just redenominate that kind of bond situation without it being an enormous volatility event. So I don't know where this is headed. I just know that it's not going to just simply go away. It's going to become an important big thing at some point, and I guess we're gonna see. And I think it's the next step. As I wrote this morning in my notes, I can't imagine that the next step isn't some form of Brussels now having to say, hey, wait a minute, we told you guys to give us the real budget, and so you didn't, and so what's going on? And if you don't start to play by the rules pretty soon, then there's going to be consequences, and I don't know what it's going to use as those consequences, but that seems like that would be the next kind of line in the dialogue here, is the reprimand and the threat of consequences from Brussels. And Italy's response to that will probably be a much more vehement middle finger, and then maybe things will start to escalate. Well, so I don't know. We'll see.
Well, maybe they're waiting to see how Brexit plays out. Do you think?
Hey, maybe. If Brexit looks pretty good, then we could have... I always thought it should be... If people say Itexit or something...
I was going to ask you that. That was my next question. Exit-Italy, yeah. I was going to ask you that question. What's going to be our little buzzword for this one?
I think it should be Exit-Italy. Everybody seems to use Italexit. I just think it should be Exit-Italy.
Yeah, you know what? I'm going to work on that. I'm good at coming up with those.
We need to get it on your blog.
Oh, man. Working overtime here. All right, so let's see. Are there any trades that you're looking at? You said you already should have been short the euro. I guess you're not looking...
I should have been short the NASDAQ and the euro right now.
Yeah.
That's why I should be talking to you right now about how great my NASDAQ and euro shorts are. So there's an implementation failure on my part.
Yeah, well, so later on we'll have our little podcast on string theory, and we can figure out how to go back and do it so we can all get short this one.
I think we can probably make that work. We got Brian Green on.
Hey, why not? I always wondered, are you friends with that sentiment trader guy? Because you seem to quote him a lot.
So I've used the service since about 2002, and I've had a couple of phone calls with him that have to do with like understanding the deeper side of the data, but we don't, go to the game and have a beer. I mean, that's been the extent of it. However, I have seen it as a very valuable tool for me because I haven't seen any other place that does such a good job of aggregating important sentiment data and inventing some. I mean, he has invented the robo ratio. That's just one of the greatest indicators I've ever come across. He had to coordinate that with clearinghouses and get data and establish a track record for long enough to show what an immensely useful tool that is. So, I respect that, and I think that it's a really useful thing. And I also think that there aren't that many other people that use things like that, which is the most important thing to me in markets. If everybody has access to the same set of data, then the data is meaningless. Mm-hmm. And so it's kind of like he's been like this little pond that I know about somewhere in the woods that, I can go fishing and it's full of fish, and nobody else knows where it is. And it's fine if all briefing people use it, but, it's not like there's millions of people keying on that data. He has, a set of subscribers probably in the thousands, and that's it. So that's a great tool. It's not muted by everybody kind of having access to the same thing. There's an edge that's represented there to me.
Yeah, no, and I understand. And, you don't want to give away the keys to the castle. That's part of the reason why I like to look at odd-timed charts. It's the same philosophy.
I did the same research. I used to program trading systems years and years and years ago, like 2001, 2002, and I did the same kind of, if you look at, or like tick charts, like, a Fibonacci number of ticks for the chart length. Like you can have the chart just in ticks rather than in minutes. But looking at like a 4-minute chart or a 7-minute chart, or moving averages that are completely not anything that anybody looks at to see if they're being, I have the same exact instinct.
Yeah, I mean, because if the only good thing about a 5-minute chart, 15-minute chart is that you do know that everybody's looking at it then it becomes a self-fulfilling prophecy sometimes, or a self-fulfilling falsifiability.
Yes, that they're exactly right. Or looking at the 50-day moving average, same thing.
Mm-hmm, mm-hmm. All right, let's see. Chinese trade war. Anything worth mentioning yet?
Probably not. I continue to have this, I think, a very I think I have a very non-consensus view that of what I think is the force in play. I haven't seen anybody else make the same argument, which may be terrible. It could be way off, or it may be good and interesting and insightful. I don't know. It just makes a lot of sense to me that China does not want an agreement. That's the thing that makes sense to me. Especially the game they keep playing, this coy game of, sending a representative over and then that person going into the office and not even opening their mouth for 2 hours and then leaving. We've seen that. And it's kind of like they keep teasing, the idea that they're trying to make an effort to stop this, but then making no effort to stop this. And I think from that view, if I'm right, then it's tremendously naive of the Trump administration to believe that they're just about to crack them, and that China's dying to make a deal and they're going to get great terms, because from that view, China would be just playing a very long game. And even if China is suffering from this, the people who are making the decisions are not. And China's got a very different philosophy about that kind of thing, a collectivist philosophy. There is ants in the anthill a little bit. And, the idea of a lot of their policies suggest that they're managing from enough of a top-down extent that they're not too worried about taking people through a bit of a tough time, especially if the people who are in power know that they can stay in power through that process and know that it is unquestionably in the best interest of the country over the very long term. And I believe that that's probably true. And even though it may seem not as compassionate to try to stop people who are actually going through a difficult time right now, it probably is true that the next 20 years for China are much better off if they do not give in to an extremely hawkish and protectionist regime in the United States. And it also, at the same time, I believe, is probably the path that makes it less likely for the Trump administration to win a new presidency in 2020. So, and mainly because, as I noted in this, primarily campaign funding in the GOP tends to come from the side of the party that is not at all happy with the tariffs. And so if the tariffs stay around, we might see apathy there when we start to go into campaign season. And again, Xi Jinping is leader for life, and the power structure in Beijing is tremendously solid. And so even though things may be tough, they can do stimulus, they can devalue their currency, they can do all sorts of little things to try and kind of make this a process that can be weathered, and think about the very long term, and think about the kind of view that they have of China over the next 50 years, and that's best going to be enabled, and probably, getting China hawks out of the White House is probably step number one, and that will not happen if they give the Trump administration a big win and they compromise on all the things that Trump wants them to, and they give in on a new trade deal, even if I think that they're doing some things that are extremely wrong. Like, I think that some of the intellectual property stuff is unquestionably unfair the way that they're dealing with that, but making Trump the savior for that is not a way to avoid future extremely hawkish protectionism coming from the United States. It's a way to reinforce the idea that that's the best way to get something done with China. And I think that if they teach us that lesson right now, it's going to harm them for, decades. So I think that that's probably what they're looking for. And I know that this is an unpopular view. Most people think that, that this is China that wants a deal, and it's Trump that's not allowing it to happen. And the moment that he starts to compromise just one little bit, they'll jump at the chance and sign it. And I guess that's the rhetoric that's being positioned around the G20 meeting in a couple weeks, and we'll see. My bet is that they will tease Trump again, and there will be no deal, and that they will back away from the table and really not participate in much actual negotiating, even if they keep propounding the sense that they are at the table and that they wish to get a deal done that's good for everybody, and just kind of keep doing that thumbs up smile and saying, we're trying to get a fair deal for everybody, here we go. And then when it comes down to it, this situation is serving them perfectly fine as is. But we'll see.
Yeah, I used the analogy yesterday, I believe, of the the guy picking the petals off the flower. She loves me not, and that's what it seems like. We're getting,
over and over again. And I think that could be, I think people blame the Trump administration probably for the structure of that process, and I think it's very possible that that's not the cause. That it's China kind of wanting to look like they're doing everything they can to work with other countries and to set up a regime going forward that seems fair, and also to look to their own population, that they're doing everything they can to try try to deal with the situation and, you know, at the same time getting into behind closed doors and really just not saying anything. That's my guess. And we'll find out pretty soon. At least we'll find out another clue at G20.
All right. Let's see. So with that said, it sounds like the most relevant or the most relevant trade that you may have on the horizon is looking for potentially an overshoot in crude down to that 5350 area, and maybe if we get an overshoot in the equity markets. Those are probably the most likely type trades.
Yeah, I would say so.
All right, after an hour, that's what we got.
That's what we got.
Right down to that, right?
That's it.
All right. Well, hopefully no one will fast forward all the way till the end. There's a lot of good takeaways from there. Good synopsis of your chart book. I encourage everyone to listen to this one again and go through the chart book. And if you have any questions, feel free to hit Chart Trader up. I know he's always good about responding to listener questions, even directly. And if they're really relevant, he'll post them on the page. And I think that wraps it all up. As always, Chart, thank you so much.
Thank you, Jim.
All right.
Okay. Take care.
You too. All right, and as we sit here, we are trading close to session lows. S&P futures here trading around the 2705 area. Looks like we hit a low of 2702 and a quarter. So as Chart and I were wrapping things up, a little air pocket that drifted down to that 2702-ish area. Got to figure 2700 even would be a zone where they want to attack, and should stops be triggered. I do have a support 2 zone on the S&P futures around 2692, so that might be an area if stops do get some traction, head things lower. Look for that 2692 area.